In this video, I want to briefly talk about commodity fundamental analysis and why we should care about it, where to use it, and how we should go about thinking about that. Before talking about fundamental analysis, I want to talk briefly about how traders make trading decisions, or what's called pre-trade analytics. Trading process, unlike what is being shown on popular media, does not rely on gut feel and emotions, but it's a deliberate process of analysis, model building, and validation. Traders rely on models to make trading decisions. In practice, there are two types of models: technical or fundamental models, or in some cases, the mixture of the two. Technical models usually rely on price indicators and patterns, while the fundamental models try to understand the causal relationship in various factors in a market leading to an intrinsic value of an asset. In the case of different asset classes, one approach might be more prevalent versus the other. In the case of commodities, fundamental approach, especially pertaining to physical assets, is more prevalent. Supply-demand balances, which we will discuss in this video, is one of the approaches used when performing fundamental analysis. Before doing that though, I want to address four main misconceptions around fundamental analytics. The first misconception is that we are trying to predict the future. While we use models and current market dynamics to develop models, which then use to generate hypotheses about the future, we don't necessarily have any ability to predict the future. The second misconception is that supply-demand balances or economic modeling is the only way to do market analytics. We addressed that in the previous slide briefly, and this might have been true in the past 10 years ago in the case of commodity markets. However, with the use of data science or quantamental approach, more and more our analysis, especially around short-term analytics, is the blend of various market models. And the third misconception is that market fundamentals always equals to price, meaning that it gives us the ability to predict price. This is not always true. Asset prices are formed from not physical drivers such as supply-demand balances, but the expectation of the value by various market participants. Or in other words, there are three F's that drive the asset values: fools, flow, and fundamentals. So fundamental factors being one of the many drivers in a given market. In the case of the commodity markets, due to scarcity of the underlying physical assets, there is always a reality at the end of the day that anchors us. In the case of equities and other asset classes, this might not exist. This also brings us to the last point, where commodities are best suited for fundamental analytics than other asset classes, where we see a lot of rule-based technical analysis type approach to develop market calls. As we discussed, commodity markets at the end of the day are governed by the scarcity of the underlying asset. Therefore, fundamental analysis is generally more appropriate. Markets. So how do we go about using market models to drive commercial decisions? Markets are complex dynamic systems, and in order for us to understand them, we need to simplify them. Models helps us to do just that. When people think about models, they think about models to predict. However, also equally needed are models to understand, models to communicate, and supply-demand models are one of the many modeling approaches we can take. In order to understand supply-demand models, we need to understand four concepts. The first concept is all commodities are generated in each region are either get consumed or get transported, and the residual molecule that is not either consumed or transported needs to be stored. Therefore, storage is a short-term balancing mechanism which has a significant impact on the value of the underlying commodity. The rate of change and not the absolute value of any of the supply-demand factors has a very important impact on the value of the asset in the future, as it determines if the market is going to be in equilibrium or disequilibrium. Asset values are then formed by the last marginal clearing mechanism, which could be, for example, a storage or a pipeline transport from one region to the other, from for example, supply region to a demand region. If we are in the state of equilibrium or congestion, a new clearing mechanism is needed to balance the market. The cost of the new clearing mechanism usually determines the value of the commodity asset in that region. While it's hard to determine the price level at any given time, thinking about commodity markets this way gives us a good idea around directional price move as well as the likelihood of congestion, which then leads to price change in price regimes or higher volatility in the market, where we can use that information to make trading decisions. So now what is the recipe for developing a supply-demand model? The short answer is there is no recipe. There are different approaches one can take. However, over the years looking at commodity markets, I've found that what I call the data science approach is the most preferred approach and superior to all the other approaches. This is to understand and to kind of outline that. This is to understand the problem we're trying to solve. In the case of commodity markets, could be understanding the value chain of the producing, transporting, and transforming the commodity, collecting relevant market data, and performing exploratory analytics, building simple models to explain various dynamics such as seasonality or relationship between factors, and then finally backtesting the models to understand whether the models, our understanding of the dynamics have been correct, and then iterating through that process over and over again until we can develop a model that we can use. So now, by the way of quick example, I want to kind of explore those concepts with you. We can choose number of commodities to explore in this presentation. They have many commonalities. However, in this presentation, I want to point to aluminum as an example. So in the case of commodities, they're, as we discussed earlier, they're generally either sourced or mined in one location. In the case of aluminum, it would be bauxite, let's say from Australia. Then it's generally pre-processed or transformed to another product, which is still not the consumer product, but it's an intermediate product. In the case of aluminum, we can point to alumina production. And then finally, the commodity is transported to a demand center from a supply region for further processing and refining, which in the case of aluminum, we can point to smelting process. Or in the case of crude oil, for example, the refineries that produce gasoline out of input crude oil. At which point the commodity is transformed to a consumer good. Along the value chain, through the process of transformation through either location, time, or property, there is ample opportunity to monetize value through optimization. Therefore, understanding value and the value driver helps us to make money from the commodities. Also, equally important is understanding where the commodity is consumed, which allows us to link the fundamentals of underlying commodity to a broader macro trends in the market. For example, in the case of aluminum, the majority of the end product is used in either transportation or construction industry. And breaking that down by country, China consumes nearly 40% of all the aluminum in the world. And that followed by EU and US. Therefore, macro trends impacting industries in these regions have a significant impact on the demand of the end product, and therefore the underlying flat price and or the value of the commodity. Having the knowledge of the value chain and demand factors allows us to look for the right places for information. There are a number of freely available sources of information depending on the commodity that you're looking for. In the case of energy, especially in North America, Energy Information Administration, or EIA, is a good place to start. For metals, especially base metals such as aluminum, OECD and USGA, which I have the links in the slide, provide a good initial data sets. There are a number of paid third-party sources such as Wood Mackenzie and IHS, where they provide information for a fee. However, I would recommend, in order to understand, have an initial understanding of a market, relying on freely sourced information is sufficient. And then as our analysis becomes more advanced, we can invest money on third-party information, which comes in some cases at a very steep fee. In the past few years, with the advent of Internet of Things and machine learning, harvesting alternative data such as text and satellite imagery have become very popular to understand trends, track supply-demand factors. A lot of the raw data is freely available online, but will require data science skills to transform them into useful information. In this slide, I have outlined a number of freely available sources of alternative data, which you can source freely. However, you would need more advanced skills around data science in order to use them. However, after this information turns into a trade signal or a information you can use to make a market call, it's extremely valuable because that information is not necessarily readily available to all market participants. So this would give you an information advantage in the market. The final step in building supply-demand balances is building a model. This could be a very simple summation of various factors to a very complex causal model. Model could then be used to assess if the commodity is fairly priced. For example, I'm kind of using aluminum again as a simple example and looking at natural gas versus aluminum prices. If you look at the historical natural gas and aluminum, we see a strong historical relationship between the two. If we regress one data against the other, we can create a model to predict the price of aluminum given the natural gas prices, which then helps us understand if aluminum prices at any given time is undervalued or overvalued versus natural gas. We can monetize this information by taking a long or short position in the market or using the natural gas or aluminum prices as a spread. It is important to understand all models are wrong, but some are less wrong than the others. Therefore, rigorous process of model building and backtesting is key for us to make our models useful for trading decisions.